I'm Matthew Williams, Senior Portfolio Manager and Investment Advisor at Williams & Associates Wealth Stewardship at Richardson Wealth. I've been reading JP Morgan's Guide to the Markets for over a decade, and what's always stood out is how some charts, a select few, keep showing up. Not just because the data changes, but because the lessons do something even more valuable. They repeat, or at least they rhyme. These aren't predictions, they're patterns, and they've helped me and helped me help many of my clients that I work with stay grounded when the world feels anything but. In this video, I sit down with Jack Manley, Global Market Strategist at JP Morgan, to unpack some of the most timeless insights from the guide and what they continue to teach us today. Thank you. We're bombarded by market noise and opinions, but some things don't change. I've read the Guide to the Markets for a large portion of my professional career, and it's possibly the most useful and consistent packages of charts that I've come across over the years. What I love is how certain charts, the really timeless ones, always give clarity when things feel uncertain. Today we're pulling out a few of those favorites. I'm joined today by Jack Manley, Global Market Strategist at JP Morgan Asset Management. The Guide to the Markets is one of the most widely circulated investment tools in the world. It's used by advisors, institutions, and portfolio managers alike to bring order to the noise. And today, we're very fortunate to have one of the voices behind it walking us through what really matters. Jack is one of JP Morgan's go-to commentators on global markets. You may have seen him on CNBC or Bloomberg. His ability to make sense of complex macro trends, central bank policy, and investor behavior has made him a trusted voice for both institutions and individuals alike. He's based in New York and plays a key role on the team managing over $250 billion in multi-asset portfolios globally. Jack, thank you for being here. I'm going to pull up the team chart, just so you can share a bit about the team behind the guide and how this research comes together each quarter.
Yeah, Matt. I mean, first of all, thank you for just a stellar introduction. What with such kind words about me, about the program, it really means a lot, and it's very good to be here. You pulled up the org chart, so to speak, and I think you get a pretty good idea that this market insights team is truly global in nature. You know, a lot of firms like to put the word global in front of a title to make it seem more important. We actually are a global organization. You know, JP Morgan is a New York-based bank. That's home office. That's the mothership. So that's where Dr. David Kelly, who runs the entire global organization, is based. But we have major satellite offices in London covering EMEA, in Hong Kong covering APAC, and then strategists really scattered around the world. We have somebody based down in Sao Paulo, people all over continental Europe, scattered across Asia, whether it's Singapore or Taipei, Mumbai, Melbourne, and then I myself happen to spend a whole lot of time up in Canada. I'm actually pretty proud. I have been to, I don't know, maybe close to a dozen cities at this point, places that a lot of Canadians have never been to. You know, I've done Winnipeg in February, I've done Calgary in January, I've done Edmonton in December. Like I get out there and I love it. To your point, Matt, you know, we've been putting out the Guide to the Markets in the U.S. for a little over 20 years. Last year was our 20th anniversary. Each one of these regions is going to have its own unique guide to the markets. There's a guide to the markets for the UK. There's a guide to the markets more broadly for EMEA. There's a guide to the markets Japan. There's a guide to the markets APAC. In the Americas, we have a guide to the markets for LATAM. I actually put together some material specifically aimed for Canadian investors, looking at the Canadian economy, a lot of different ways to approach these data, and then a lot more that we offer. We have a blog. We have a podcast. There is an embarrassment of riches when it comes to content coming out of the Insights team, and I'm just very, very thrilled and honored to be able to be a part of that.
Oh, that's great. Thank you for that background. It's you know, it's quite impressive, and I'll say I have to admit you have definitely more Canadian travel badges than I do. Jack, you're a brave man for some of those locations and timing. Great. So let's start with something that you know that typically surprises people, and it's about confidence, or more specifically, what happens when investors don't have any or have too much. This one reminds me of why discomfort can actually be a signal.
Yeah, it's there's an old Warren Buffett adage that people like to quote when we're talking about markets, and it's this idea that you want to be fearful when others are greedy and greedy when others are fearful. And I think that this chart from our Guide to the Markets does a really good job of sort of painting a picture to that effect. So we can kind of walk through this very briefly. You can see on the x-axis, we go all the way back to 1971. So we got about 50 plus years worth of data on this page, a lot of information that we are covering. And we're charting a University of Michigan derived American Consumer Sentiment Index. And what we've done on this chart is annotate the local peaks and the local troughs. In other words, when people are feeling really, really, really good about current conditions, those are going to be the peaks. And then really, really, really bad about current conditions, there's going to be the troughs. There are 10 of those peaks over this time period, 9 of those troughs. So over 50 plus years worth of data, we have 19 points in particular that we are paying attention to. And what we've done on top of this is calculated what the 12-month forward return was out of the S&P 500 if you had invested at one of those peaks or one of those troughs. So basically, like if you're investing when everybody's feeling great, what was your return like? If you're investing when everybody's feeling poor, what was your return like? And each one of those blue dots is going to have that subsequent return, but we kind of sum it all up and average it in the table on the top left side of this page. Now, I think this is pretty stunning. And to your point, Matt, it's not something that I think a lot of people would necessarily expect. The average subsequent 12-month return out of the S&P 500 U.S. large cap stocks, if you're investing at one of those 10 sentiment peaks, is under 4%. Now, that's not bad. I mean, a 4% return is fine. But look at what happens if you're investing at one of those sentiment troughs. Your average 12-month forward return is 6 times that. It's north of 24%. Now, of course, what is it? Past performance is no guarantee of future results. We cannot guarantee that if you invest at every trough, the market's going to take off like a rocket ship afterwards. But history is a pretty good guideline, and we got a lot of data on this page. And with so much going on right now from a policy change perspective, so much uncertainty with the economy, with interest rates, a lot of volatility in markets, a lot of nervousness from investors, this is a very, very good almost principle, I would say, of investing to remember that, maybe it is always darkest just before the dawn. Maybe, when you're feeling horrible and tempted to make an emotional rash decision, look at this chart and remember that oftentimes those troughs can be pretty attractive entry points for investing.
Yeah, that's great. I almost have this. I have this sort of small heuristic that, when all I can see or hear around me is negative news and people's description of the end of capitalism or the end of the world or whatnot, that I'm just like, the worst must be behind me at this point in time.
Yeah. Well, I wish more people felt like you, Matt. I mean, that's really, it's good to be able to look optimistically, to put a positive spin on something.
Right. No, that's great. That's great. And so this next chart is one of the selections from your team, Jack, and it's especially relevant given how much airtime the Fed gets these days. What I like is that it adds historical context to something that tends to be treated like breaking news. And I'll just pull it up here. And so this is the Fed and interest rates.
Yeah, I mean, I would say maybe I overly simplify when I think about markets, but my kind of overarching message whenever I'm talking to any investor is if you want to have a view on what's going to happen with markets, that's stocks and bonds. If you want to have a view on what's going to happen with markets, you have to have a view on interest rates. Because when you think about interest rates, rates are the cost of money. The cost of money is going to impact economic variables, of course. But when you think about those assets in your portfolios, stocks and bonds, the level of interest rates and the direction of interest rates is going to tell you a whole lot about how those assets are going to perform. You think about fixed income, the bonds that you're holding, the level of interest rates helps to inform the coupon, the direction of interest rates helps to inform the role of duration. When you think about stocks in your portfolio, interest rates are going to help to inform what a reasonable valuation might look like because they become sort of the hurdle. They'll help to inform what future earnings growth may look like because it's the discount rate that you'll apply to those future cash flows. Having a view on interest rates and monetary policy, whether it's the Bank of Canada or the Federal Reserve, is critical for having that view on markets. And that's why I suggested that we talk through this slide, because if there's one page that helps to explain what's been going on in markets from a 30,000-foot view, this just might be it. So to your point, Matt, you got a lot of history here. That's one thing you'll notice as you flip through the guide. There's a lot of history. We give you a lot of data showing what the federal funds rate has been really over the last 30 years or so, that overnight rate that the Federal Reserve actually happens to control. But the most interesting stuff that we show on this page is going to be the combination of the table and then the stuff that we have on the right-hand side, the dotted lines, the shaded gray area. That's where I really want to pay attention to. Everybody's trying to have a view on what's going to happen with interest rates over the next 6 to 12 to 18 months. And it's very, very difficult to formulate that view. But the Federal Reserve does this thing that almost no other central bank does, that the Bank of Canada doesn't do this, for example. It publishes an extraordinary amount of forward guidance. It tells the market exactly what it's thinking. And it does that through something called the Summary of Economic Projections, or SEP. Now, that SEP tells us what the Fed thinks is going to happen with GDP growth, the unemployment rate, and both headline and core inflation this year, next year, the year after that, and what they refer to as the long run. That's going to be like 5 to 7 years or so. They put out that SEP on a quarterly basis, which means the last time we got one was in June. And so you can see on the table here, right, these are the June 2025 forecasts. Now, alongside that SEP, the Federal Reserve also tells us what they're planning on doing with interest rates if those projections end up coming true. And that's what's referred to as the dot plot. And we show that on the right-hand side. That's that dotted blue line. So when June rolled around, the Federal Reserve published its quarterly SEP. It took its GDP growth expectations, revised them lower, their unemployment rate expectations, revised them higher, their inflation expectations, revised them higher. They basically were saying, all this policy uncertainty, all this trade war, tariff nonsense, it's going to hurt the U.S. economy. Maybe not enormously, but it's going to hurt the U.S. economy. And they also told us, as a result of that view, that they were planning on cutting interest rates. Now, that dot plot, that sort of dotted blue line on the right-hand side of this page, it tells you what the Fed told us back in June. But don't pay too much attention to those numbers. These are guidelines, not rules. The Fed does not actually know what it's going to do with monetary policy next year or the year after or over the long run. I mean, how can it possibly know that when it doesn't know what tomorrow is going to look like? It can't know what monetary policy 3 years from now is going to look like. And we have to acknowledge that while we can be reasonably confident that the Federal Reserve, like the Bank of Canada, is biased toward cutting rates, we also have to acknowledge that basically everything beyond that is a guess. Both of these central banks have been on hold for several meetings now. We don't know when that cutting cycle is going to resume. It might be September. It might not be. Once the cutting cycle resumes, we don't know how many cuts they're going to be, how big the cuts are going to be, how frequent they will be, how long they're going to last, what the ultimate goal is, right? What the target is. All of this stuff is up in the air. It's anybody's ballgame. And the good news, I would say, for any investor that is scratching their head and wondering, what are these banks going to do about monetary policy? The good news is that you're not alone in that confusion, because the market has no idea what's going on either. We show, again, on the right-hand side of this page, a dotted green line. Those are market expectations for what the Fed's going to get into. Right now, you can see a divergence, right, between these two lines. That's not particularly unusual. The market and the Fed aren't always on the same page. Way more interesting is that shaded gray area. It's light gray on the right-hand side. That's everywhere that green line has been since the start of the year. Just whipsawing rate expectations because nobody knows what the heck's going on with policy and nobody knows what the heck's going on with the economy. And that volatility in rates helps to explain a lot of the volatility that we saw in the U.S. equity market market in the first half of this year. So I think a really important page to check out, to pay attention to if you're trying to get a sense of where rates are going, which again, I think is pretty important for figuring out what's going to happen with markets.
Yes, I mean, that's such a great point. I mean, one of my a couple of years ago, I had a book delivered to my house, and my spouse had said that it looks like the most boring book that's ever entered our house, and it's called you may have seen it. It's called A History of Interest Rates, and the authors the authors track back implied interest rates back thousands of years and stuff like that, and sort of
Wow.
two sort of big lessons that kind of come out of that is one, like interest rates are incredibly volatile. Like it's hard to your point on the gray shaded area and expectations and so on and so forth, and how hard it is to predict really like what's going to happen with interest rates. But then also, to your point around what's going to happen with markets, it's like I have been saying to clients and anyone who listens is that returns are related to each other, right? If you can, if you can get a higher kind of risk-free rate, well, then, that increases the hurdle of what you would expect in any other riskier asset class. So, it's, you need to, it does kind of set a bit of a benchmark for everything else.
Absolutely. Yeah.
Yeah, that's awesome. And so this next one, we're going to kind of shift a little bit from macro to mindset. And there's a stat that I keep coming back to, or an idea that I keep coming back to with clients is that, in most years, markets drop double digits and still end up, positive. And this next chart shows, exactly how that plays out. So Jack, what sort of stands out to you here?
This is probably the most popular slide in the Guide to the Markets. And I've been on the Market Insights team for almost a decade at this point, and this slide predates me. It's one of the few slides that is truly evergreen. And I kid you not, I mean, you might be one of these guys yourself, Matt. I kid you not. I've walked into advisors' offices and it's blown up and framed and hung on the wall. People love this page because it takes something very complicated and prickly, which is volatility, and it distills it down to something that's understandable. And I think that if you can understand something, you don't necessarily have to fear it as much. And that's really where the power of this page comes from. So it's S&P 500 returns, right? Calendar year returns in gray, going back to 1980, so 45 years worth of returns. That's what those gray bars are going to be, what the S&P did in any one of those calendar years. We also show the largest peak to trough decline experienced in any calendar year by the S&P 500 and annotate that as one of these little red dots. So there is your intra-year declines and calendar year returns. That's how we think about this page. Now, there are a few, I think, really important takeaways from this slide. The first one is look closely. There is not a single year on this page where there isn't a little red dot, right? Because there has never been a single year in the history of markets where it's gone up every single day. There's always at least something of a pullback. So already right off the bat, we can level set and say volatility is a pretty normal part of what it means to be an investor, right? It's something we should expect even a little bit, but we should expect it every single year. Much more impactful, and this I think is to your point, Matt, about how often double-digit declines actually happen. You can see, looking at the little subtitle on this page, that the average peak to trough decline experience going back 45 years, it's not 1 or 2 or 5%, it's over 14%. Double-digit decline. That's the average that we've seen over this time period. Now, you look all the way on the right-hand side of this page, and you can see in the aftermath of quote-unquote Liberation Day, right, early April, the U.S. equity market wasn't particularly happy, flirting with a bear market down 19%. Now, a 19% pullback, that sounds terrifying when your baseline is 0. It doesn't sound as scary when your baseline is minus 14. You can say that, okay, this year's been, worse than average, but only by a little bit. And then I think perhaps the most important thing for us to kind of bring ourselves back to is that despite the fact that every year there's volatility, and despite the fact on average those pullbacks are north of 14%, we can also see that in 34 of the last 45 years, or right around 75% of the time, the S&P 500 closes the year higher than where it started. So yes, volatility, it's here. but it's a normal part of being an investor. And there's a very good chance that if you're a long-term investor, it is not going to derail your long-term success story.
Yeah, that's great. I mean, it doesn't surprise me that it's blown up on people's walls. It's a nice reminder, from that perspective. Um, this next one is a team pick. Oh, sorry, no. This next one is about perspective. I often say that risk isn't about how much something moves, as we just kind of talked about in this last slide with volatility, but it's about how long you give it to work. And this chart says it better than I ever could. I'm just going to pull this one up here. So, Jack, can you walk us through what we're seeing in here and how investors should be thinking about time potentially as an asset?
Absolutely. I mean, another really powerful one, Matt. You pulled a lot of good stuff for this discussion. So again, a lot of data in the guide to the markets. You can see, looking at that subtitle here, that we're looking at data going all the way back to 1950. So almost 3/4 of a century worth of information on this page. And what we do is we look at the range of total returns for stocks as measured by the S&P 500, bonds as measured by the Bloomberg US aggregate, and then a 60/40 portfolio combining those two things. Depending on if your holding period over this entire 74-year time period was 1 year or 5 years, 10 years, or 20 years, starting left from right. Now you look all the way on the left-hand side of this page at those 1 year rolling calendar year returns, and what becomes pretty clear is that over a year, basically anything can happen. I think that's particularly true when you're looking at stocks. There was 1 year where the S&P 500 was up over 50%. There was 1 year where the S&P 500 was down almost 40%. I mean, the range of potential outcomes for stocks, even bonds, and by extension a 60/40 portfolio is extreme. But as you move further and further to the right-hand side of this page, you increase your holding period. You'll notice that the bars get smaller, that the range of potential outcomes actually starts to shrink. And by the time you've hit a 5-year rolling period, you've actually never lost money in a 60/40 portfolio. And by the time you hit a 20-year rolling period, you've actually never lost money in stocks. I think the phrase that really resonates when we're looking at a page like this is that it's not about timing the market. It's about time in the market. And to your point, Matt, being a long-term investor is in and of itself an asset, I would say, for portfolio construction. And this page does a really nice job, I think, of telling that story.
Yes, that's great. It helps for clients and advisors to also think about that in terms of how they select an allocation for people. It's sort of you don't want to really use stocks as a bank account from that perspective, as you can see in the 1 year sort of range from that perspective. And so this next chart is the one I was maybe getting ahead of myself on the last one, and this is a team pick from you guys, and I have to say I can see why. It's one of the most visually striking charts in the whole guide. Jack, I'd love to hear why you and the team included this one and what investors should take away from it.
Yeah, so we call this the Quilt chart, Matt, for hopefully pretty obvious reasons, right? It's kind of a patchwork of all these different asset classes. That's what each one of these colors is going to represent. You got stocks, bonds, domestic, international, large cap, small cap, high quality, low quality, commodities, real estate, cash. Like, we got a little bit of everything on this page. And one of the things that you'll notice, I would say, that should strike you as you're looking at this slide is that in any given year over the past 15 years, it's been basically impossible to predict the winners or the losers. And that's because in any given year over these past 15 years, it's been basically impossible to predict that next big source of volatility, like good or bad, next big source of volatility that's going to shake up markets. And whenever I'm talking to clients and using this slide, and for what it's worth, I use this slide every time I'm giving a presentation or a speech. I love this chart. One of the things that I always like to remind people about is, like, it wasn't that long ago that we weren't talking about a global pandemic, that we weren't talking about a land war in Europe, We weren't talking about a regional banking crisis in the States or large language models in ChatGPT or, full-blown war in the Middle East, the U.S. bombing Iran, tariffs, trade wars. I mean, this stuff happens so quickly. And you can do all this planning and all this thinking, and it all just gets shattered in an instant by one of these big kind of tail risk surprises. So instead of trying to predict that next big source of volatility, you got to do the next best thing, which is prepare for it. And the way you prepare for it is by owning a little bit of all this stuff that we show on this page and being a true asset allocator, diversifying. The problem here, Matt, I would say, and maybe you've come across this too, but the problem here is that talking about diversification, it's often a lot easier said than done. We live in this world where there's so much like instant gratification at our fingertips that so many people that I speak to, they just want to shoot the moon. They're like, why would I own bonds when I can just own stocks? Why would I own European equities when I can just buy the U.S. and just buy growth? Why would I own any of this stuff? I could just buy crypto and maybe that'll make me rich. But we are not day traders. We aren't chasing performance. Our whole thing is that we are long-term investors looking for long-term investing success. And I think we have to remember that oftentimes the journey is going to be just as important as the destination. And what you can see looking at this little gray box that's going to represent asset allocation, it's smooth and stable. It's the thing that helps to get you across that finish line safely and comfortably. So a really powerful chart, I think, for helping to make that point about why you want to be diversified, even though a couple of things have been working really, really well over these past few years.
Yeah, I think that's great. It's certainly a chart that, if as an investor, if you want to be reminded or reminded to have humility in this practice, to take a look and and just be reminded that some of those predictions are very difficult year by year from that perspective.
Yep.
And so this will be our last chart actually, and it's one of my favorite myth busting charts. I can't count how many times someone has said, should I just wait for a pullback? And yet this chart shows that answer hiding in plain sight. So I'll just pull this one up here. Let's walk through this one. What does history tell us about investing at market highs?
Yeah, man, all-time highs can be pretty intimidating. And I feel like when markets are at or near all-time highs, and that's where the U.S. equity market is right now, we're at or near all-time highs, a lot of investors are just kind of waiting with bated breath for the shoe to drop and the whole thing to fall apart. They're afraid of all-time highs. And what this page helps to do is put those all-time highs into perspective. Now, the first thing I want to point out is I've been able to kind of refresh the data on my end. There have been 15 all-time highs in the U.S. equity market so far this year. And as we can see, looking at this version of the chart, 60 plus all-time highs over the 18 months up until when this was printed. All-time highs are actually a lot more normal than you'd think. And that's what those statistics on the left-hand side of this page show you. Roughly 7% of all trading days result in an all-time high. Now, there are 252 trading days. 7% of those means that roughly every 3 weeks, you're expected to hit an all-time high. The other statistic that we show on this page, though, is the percentage of all-time highs that end up acting as what we refer to as a market floor. In other words, if you want to read all the details, it's in the footnote, but this idea that the market hits this level and it never goes more than 5% below this level at any point ever. And we annotate those all-time highs that are market floors using those green dots. But you can see that of all those all-time highs that the S&P 500 achieves, roughly a third of them end up being new market floors. And so you run the math on that one, and it means that, okay, every 3 weeks or so, you're expected to hit an all-time high. Well, every 2.5 months or so, you're expected to hit an all-time high that now becomes the new market floor. So first things first, right? Don't be worried about the fact that the market's at an all-time high. It's actually not that unusual. The other side of this page, I think, is just as powerful, telling a slightly different story. It's your investment experience if you invest at one of those all-time highs. And here we got data going back to the late 1980s. So, between 35, 40 years worth of information on here. Daily data, though, so there's a lot of data points that feed into this chart. And we show you what the average cumulative S&P 500 total return would have been over all these different rolling periods. We show those on the x-axis if you had invested at a new all-time high in green or invested on any random day. And I bet you, I know you mentioned that this is something of a mythbuster chart. I bet you a lot of people would be shocked to know that over a 6-month all the way up to 5-year and beyond rolling basis, investing at an all-time high has actually yielded a better return than investing on any random day. And that's because momentum begets momentum. All-time highs beget all-time highs. So not only are all-time highs actually not that strange, they're fairly typical. I think having that math around there really helps to put them into perspective. But also investing at an all-time high might be a pretty good investment idea. So I think a really, really nice page to sort of cap off this conversation and remind people that even when things are going great, they might still do better.
That's great. Thank you so much, Jack. This has been fantastic. Thank you again for walking us through those. The context you shared around each chart really brings them to life. For anybody watching who wants to dig deeper, where can they find more of your team's work and follow along with the guide?
Yeah, so it's going to be on the JP Morgan Funds website. That should be a pretty quick Google search. And when you're on the JP Morgan Funds website, there is going to be an Insights tab. Underneath the Insights tab is Market Insights, and that's going to be my team. On that Market Insights tab, you're going to see the guide to the markets. You're going to see the material that I make specifically for Canada. I call it the Canada Economic and Market Update. It's actually a lot of charts like the ones that we just went through, Matt, but tailored towards Canadian investors about the Canadian economy, Canadian interest rates, Canadian equity market. You'll find our blog. You'll find our podcast. As I mentioned earlier, I mean, more stuff than you'll ever know what to do with, but some really, really helpful things to chew on as you're trying to digest and understand, how to make sense of what's going on right now in the global economy and global markets.
That's great. Thank you so much. And of course, if you're a client or someone trying to make sense of what this all means for your own investment plan, feel free to reach out. This is exactly the kind of perspective we try to bring to conversations every day. Thanks again, Jack. Really appreciate it. And thank you all for watching.